cannot be traders for 5 to 8, 10 pips. We just will not make it if we do that, okay? We have to be a 90% trader for the rest of our lives if we do that. So what we have to do is learn to target trade. And there's some tools that are on virtually every chart that allow you to find the targets, okay? And so we're going to kind of go through this real quickly here and just kind of give you a little primer about how you need to learn to use these tools, okay? So I'm going to just pull up the euro dollar here, okay? Now, I'm on a 10-minute chart, and the first thing you have to know is that you have to get off this chart. The thing you have to know is the big boys targets, and the big boys targets are not on a 10-minute chart. The big boys targets are found on the day chart, the 240 chart, and the 60. That means the 240 is 250 minutes or 4 hours, and the 60-minute is a 1-hour chart. So the first thing we're going to do is take this up to a day chart, and now we can see the big picture, as you can see. All right, now what I want you to see here is I'm going to put this kind of big like this just so we can see. And we can see that this whole thing right here is one leg, okay? This is all connected. Even though we had this little move up, it's all connected. Can we see that? Then down here you can see that this whole area right over here is all connected. This little area is one little piece. This little piece is one little piece. Over here, this is one little piece. So you can see that these are all called legs. A leg down, a leg up, a leg down, a leg up, and a leg down, and now a leg up, okay? Now the most important thing here, however, is to understand that the retracements, the moves that counter balance these down moves or these up moves, are all done to Fibonacci's. Now every chart that's got any worth to it at all has a Fibonacci retracement key on it. All right, so the main thing to understand is that this little key, and I'm going to pull it up here, if we just take the leg, it's important to understand the leg from the top to the bottom, will give us these values that the market is looking for. And the values that they're looking for is the 382, the 500, the 618, and occasionally the 786 Fibonacci retracement value. Now we can see after the fact here that the market came up to the 382, turned, and came back down. But what's important for you to understand is once this leg is in place, that information was readily available to you. So if you're looking at it right here and you see the market moving up, you can absolutely take this leg and find these targets, okay? Now, professional traders, they'll trade to these marks and then trade off of them, all right? Now, as an aggressive trader or an advanced trader, you would do the same. But as a novice trader, you're not looking to trade counter trend. What you're looking for is to wait for these targets to be hit and then trade off of those targets, okay? But either way, the important thing is to know when to trade, okay? So if you're trading this thing down and you've made some good pips and the market bounces back up, do you want to risk your money that you made good pips here and trade it to these targets? Depends on your skill level. If you have the skill level, you trade to these 382, maybe the 500, maybe the 618. If you don't have the skill level, you put the same targets on here and you wait for the big boys to hit the target, okay? That's what's important here. All right. Now, once we have these Fibonacci's on a day chart, or where we can really easily see what legs belong to each other, we then take it down to a 240 chart. Now, on the 240 chart, let me auto scale this a little bit, and you can see now these are all 4-hour candles. Right? Every candle here is worth 4 hours, okay? So, you know, you're going to trade for about 4 hours. So you can see we've got several days worth of trading here, okay? So this move that looked like a straight move up is not straight at all right? But notice exactly when they hit this 382 right here, what happened? They reversed, okay? Now, so what was the target when they bounced off the bottom? The 382 was the target, okay? And traders make these trades all the time because they know that the market cannot continue this unabated right here. All right? This whole move down cannot continue down. It's not possible. Okay? So They know that the market is going to retrace. They begin the process of entering trades to this target right here. At this target right here, then down they go again. Okay, you can see that. Now let's take this down to the 60-minute chart, and let's just simply go back in time and see what would have happened at this 382. You can see there's the line for the 382. Look at where we get a trade. Immediately off the retracement, as soon as it hits that line, the sellers come in and down they go. Okay, you can see that this is giving you a complete piece of information that will help you. You can either trade it up to the line, as long as you know where that line is. Now, this will help you absolutely nothing if you're trading for 5 to 8 pips, because your piece of that little move right there is 5 to 8 pips, as opposed to 1.3132 up to 34.71. So, it's a 240 pip move, of which you may be lucky to get 5 or 8 pips out of. All right? Why? Because you don't know where the target is. And then as you get close to this target here, you decline to make trades here at this area right here and opt for, I'm going to wait for the reversal, and there it comes, and there's your trades down. You see that? That's easy. It's not hard. There's no rocket science here. Let's go look at a different chart. Let's pull up the British pound right next to it. All right? Once again, it opens on a 10-minute chart. That's where we enter trades, but that's not where we make our decisions. Our decisions are made up on the day, the 240, and the 60. So we're going to immediately change this to a day chart. And let's look and see if we didn't have the same thing here. All right? So we can see if we're scrolling this over and all of a sudden we see it going up. Okay, we now know it's going up. Regardless of when you open up this chart, we know this is going up. So where is the target? The target is very simply put the fibs from the top to the bottom. Okay, now that's going to give us a 382, a 500, a 618, and a 786. Now, something that's very important to understand here is that we don't know which one of these fibs is the one the big boys are looking for. We don't know that. But we know it's one of them. That's the key. So anytime you have a trade that manifests and you have room to your target, and you can put good risk reward trades, in other words, if it's 40 pips away and you can put a 40 pip or less stop on it, then it is a reasonable trade to make. However, counter trend moves are trades that are much more dangerous, and you can tell that this is going to be any move up. It's a counter trend move. How do you know that? You see this moving average moving down? It's telling you the trend is down. Okay, look at this whole move up, and the trend doesn't change, because good charts tell you what the trend is. Okay, they tell you what the trend is, and they are not concerned with these up moves. All of this move that came up and up and up is simply nothing more than a move to get in position to go down, and down they go. Now, we've bounced and we're coming back up. We can all see why they bounced. I'll just put a little line over here, and you can see that there's a support, a resistance right over here. So, there's a support. So they bounce on this. So where is it going? It's going to one of these fibs. So let me take this again down to a 240 chart, and you can see this bounce off this fib, and up we go. Notice how they went right up to the 382 and stopped and came back down. Now, if you'd have made the trade from the 382 down, you'd still made 40, 50 pips, okay? And then it comes back up again and goes down again. You still made 40, 50 pips. Comes up again and comes down. You still have made 30 pips, okay? And of course, when they hit the 50%, which is typical where they go to. Why do they do that? All right, this is a 50% Fibonacci. What does that mean? That means that this whole move over here, where we took this top from this very top, let me just scrunch this down, this top all the way down to here, the 50% is a 50% discount on the currency. If the market is going to continue to go down, you just got a 50% discount. There's no different than what happens when you walk into a department store and you're walking in there and you're going over to the landscape department to buy a lawnmower. And as you're walking to the lawnmower, you hear this loudspeaker come over, and it says, "Attention shoppers, there's a 50% sale on underwear today," in the underwear department. Now, you went in there for a lawnmower, but hey, everybody can use underwear, especially at 50% discount. And so you walk over and grab you a pack of underwear on your way to the lawnmower show, place. That's how it works. There's no difference here. All they're telling you here is when they hit the 50%, there has been a 50% discount in the Greater British Pound versus the US dollar. Okay, so as the market hits that 50%, look at the sale that comes off that 50%. Now, we knew the target going up, but most importantly, we knew where to enter for the sell going the other way. All right, let's mark this little part just like we did on the last one here, and we'll mark this 50%. And now we're just going to take this down to a 60-minute chart, and we're going to take a look and see what happened at the 60-minute. As you see, there was a great trade up to that target, but notice they knew exactly where that target is. Now, professional traders made 100 plus pips to that target right there. Retail traders made 5 down in here. Okay. Now, when it turns around and goes down over here, retail traders made 5 pips, and the professional traders made 200 pips. You see? Why? Because they know the targets. They know what they've hit. See, it's just as important to know when to trade as it is to know when not to trade. Right? So the key is right here, as you can see, we have an arrow and a painted candle, which is a trade signal for us. Okay. Now, a trade signal this close to the target says, be careful. This is not probably an area you want to take a trade here. You want to wait for the reversal. And of course, the reversal immediately comes, and down she goes for 100 pips, and then down she goes for 250 pips. You see that? The market knows where these numbers are, and you have to know about them. All right. Now, let's just take this little currency right here, and let's while we're here, let's use Fibonacci's for the interim movement. Okay. So you can see here that we have now a leg right here from this bottom, rolling right back up to this top. Okay, we could put another set of Fibonacci's on here, which includes Fibonacci extensions. Now, Fibonacci extensions are really, really powerful because they give us targets further than 100%. Okay, so we simply take this from here down to this leg right here. All right, you see this leg from here down to here. Right? Now, in this case, they did not quite get to the 382, and they turned and they went. Where are they going? All right. Now, I'm just going to show you a couple of things. Here's a Fibonacci extension. Here's a Fibonacci extension. And here's a Fibonacci extension. Wow. Is that where the market's going? Yes. Can you know that ahead of time? Yes. All right. So, let's just see what happens. All right. Now, you can all see that we need to break this bottom, but breaking this bottom gives us some targets, okay? And anytime we're trading, we're looking for an opportunity to trade to that level. Well, you can see they missed this one by 4 pips. That's all they missed that one by, 4 pips. All right? But remember, we still have targets down here. All right? Down we go, and let's see if we get there. And that's where we currently are. So we're still trying to get to this target right here. Understand something, however. We already know where the target is. We know where it is. And anytime we get an opportunity to sell here, we know where the market is trying to go, is to that next target. If you don't believe me, look back here. See how they went right to here? See how these numbers, they know exactly where these numbers are. So if they know where this number is, they know where this number is. All right? So let's just take this trade right here, this little area right here, and let's look how this would have worked for us today. Knowing that we already have these targets, I'm just drawing a line on here so I can find it when I go down. All right, so now you can see that here we are. All right, this is where the market turned. You can see that we had a perfect trade for us. Okay, for us, it's the arrow turns to bright red. Especially, it's really powerful if you get a white dot on ahead of it. Okay, so it takes off. Now it runs down to these T30s. Now if you were in the last video, you remember that a T30 is nothing more than a 30 pip target. So there's 30 pips to this line, 30 pips to this line, 30 pips to this line. And you can see by target trading alone, we'd have known every time we moved to this next T30, okay, on the way to this target down here, the 618, which it has not yet gotten to, all right, we would have still been able to move our stop at every one of these lines. As soon as it broke through here and went to this target, we move our stop. Breaks through, it goes to this target, we move our stop right above this T30 here. All right, and we're we're comfortably in the trade. We have profit that's guaranteed, but we're still in the trade when it makes the move all the way down here to the 53.01. We're currently at 53.94. This is live charts, okay? So there are still 93 pips to the target, all right? And we have plenty of opportunities to enter again and again and again. We can see that the market is really in a downtrend because of this moving average right here. Remember, good charts always tell you what the trend is. All right, you don't necessarily need to find the trend if you have good charts, because the moving average will give you the trend. So these up moves are nothing more than going into the department store to go buy a lawnmower and finding out there's a sale on underwear. It's the same thing here. Right now they're giving everybody a sale on underwear. Why? Because they need sellers to come in the market. Down in this level right here, the sellers are not interested. Why? Because they know that a retracement is imminent. But at the top of the retracement, the sellers come into the market. Why? Because even if it comes down here to the bottom and just makes a double bottom down here, we'll just put a little line on here. Even if it made a trip only to here, and that's all it could do, is at 53.93, and this bottom is 53.41, you have about 40 pips there. And they can make money, even if it doesn't break to the target. You see? That's why target trading is so important, because it takes you out of the 5 to 8 pip realm, puts you in the realm of the big boys. Now you're trading with the big boys. You're seeing their targets, visually seeing them, and you're able to stay into the target. Why? Because you know where it is. See, one of the reasons that people trade for only 5 to 8 pips is they don't know where the currency is going. And because they don't know where it's trying to go, having 5 or 8 pips of profit makes it look really enticing to click the button and put it in the bank. But the easiest way to put it in the bank and still be in for the targets is simply to move your stop into profit. Okay, had we traded right here, as you can see right here, that would have been our signal right there. Had we traded right there, okay, we could have simply moved our stop currently right now to just right over here, right here. All right, now that's 51 down to 18. Okay, so we got about 33 pips that we could guarantee would be in the bank. Okay, by just moving our stop to here, we have 33 pips that's guaranteed in the bank, and we're looking at the possibility of going for another 1, 2, 3 T30s, which is 90 pips, plus some more, about 100 pips more. So this trade could end up making us 130 pips, but the worst it can do is make us 33. And 100 plus pips or 33 pips beats the heck out of 5 to 8. And now we don't have to be the best trader in the planet. We can simply trade and make money. We have no stress, none whatsoever. We know where the target is. We're gonna see it through. It's very similar to when you get on a freeway near your house, or if you're in London getting on the M1 or the M2, something like that. You get on that thing. You're not sitting there and staying on it forever. You have a destination in mind. In other words, you have an exit. You know where you're gonna exit to get off that freeway. Same thing here. We're going to exit on this freeway at 53.01. It doesn't matter that it takes it a while to get there. It doesn't matter that it bounces up and down. As long as we know where the exit is, we'll take the curves in the road and be able to trade it to these areas right down here. All right? So we have two ways to find the targets. One of them is these T30s, if nothing else, just trading it to the T30s. And you can see the market knows where the T30s are as it comes down. Why did it stop here? Because there was a T30 here. What is a T30? It's based off of the pivot point. And a pivot point is something that big boys use. We found a way to use it down here in our charts. It's not important that you know where a pivot point is. What's important to know is that you know where the target is. All right? We know where the target is. These are interim targets on the way to the bigger target. And the bigger target is this 618 fib extension. All right? Right down here. Now, that fib retracement and fib extension can dramatically change your trading. Dramatically. All right, let's just do another chart. And by the way, I haven't looked at the charts. I'm just pulling them up as we go. Let's go look at the Euro Japan because we had a pretty good little move in the Euro Japan today. There it is right there. So remember, our first thing we got to do is we got to go up to the day chart. We got to see what the big boys are seeing. And we can all see really quickly here that we're actually trading in a very sideways move here. Although we've had up and down movements, you can see that the top is here and the bottom is here. You don't have to be a rocket scientist to figure that out. Okay, it's very simple. You can see that. All right. Now, what's important here is we have a leg over here. Let me make this big so you can see it. All right. Now, make this nice and big. There's a leg right there. Therefore, this is a retracement to go down. In other words, they ran out of sellers here. So how do we find sellers? Discount. This is the underwear story. We got to move up to find the sellers, and then now sellers will come in and drive it. We can already see that the target is more than likely this bottom right here. But let's prove it using what we already know. We take a Fibonacci and we simply click it from the top of this leg, that's this leg right here, down to this bottom. Gee, there they go. There are these targets right here. Now let's take it to a 240 chart. I'm just going to expand this up a little bit so it's easier for you to see. And we can see how the market moved right up to this 382. Notice how they stopped there and came down. All right. That's still a 30 pip trade right there. Up they go again, trying to get. They're looking for sellers. They need lots of sellers to take it down to this target down here. They need lots of sellers. Okay, there aren't enough of them. So there are some here. Down they go, and they're not able to get there. What happens at the 50%? The sellers come in. Okay, there's still not enough sellers. So up they go, and they keep going, and eventually they top out right here, trying to get to the 618. They're not able to do it, and over they go. Now, for us, trades up to these numbers become great targets. Okay, why? Because we can see already, just doing a couple of charts, that the market knows where these lines are. The 382, the 500, and the 618. Now, there are whole primers on Fibonacci's, and on the website we have tons of stuff of tutorials on how to understand Fibonacci's. I'm not trying to go through the Fibonacci and how to use it. I'm just showing you that target trading makes the difference here. Okay, so let's go down to the 60-minute chart now. Let's just see what happened when we ended up at that top and turned over. Okay, well, before we even do that, let's see how many trades we would have had up to this trade. Here's a great trade here. This is the move from the bottom up to the 382. Notice how great that trade was. What we would have known at this point, be careful because it's a reversal point, and we would have moved our stop and traded to that point right there. All right, they were not successful in breaking it, so down they come and up they go again. Look at right to the 382, and then they come up here and right to the 50%. Now at the 50%, things change. The sellers start coming in like crazy, but as you can see, there weren't enough sellers to take the currency all the way down here. So what do the big boys know? They know we got to take it higher, and they take it up higher and higher and higher, and eventually they find enough sellers to turn the market down. You see that? All right, so let's take this last little move here, all right, and you can see here's where we are, and we came right back down to, remember the target? Here's this down move, and down they came all the way down here. All right, so let's just mark this one right here. We'll start right here, so we can see what would this look like down on a 10-minute chart. Let's take this down to a 10-minute chart. Once we know they've made the turn, why? Because they've hit the target, therefore the up target is gone, and the down target now becomes the new opportunity. All right, so here's where they turn at the 50%, and it takes them a while to get out of their buys and into sells. Notice, great trade down right there. Notice right here. Now remember, these trades are moving further than 5 to 8 pips, folks. They're moving 5 to 8 pips, and as you come down, you know that there's a target sitting right here. All right, and as we continue to move down, we know there's a target way down here. Look at all the opportunities to sell, 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 sell. Continuing. Now we get a little up move. Why? They ran out of sellers here. So what do we got to do? We got to give them a discount. Let me make this big, and you can see now that here's the top of this move, and here's the bottom of this move. This is a leg. So we'll put another set of fibs on from here down to here. Very simple. Notice 382, the 50, and the 618. Look what happened at the 618 right here. Right? See, it doesn't matter what time compression you're using now. The bankers are trading with fibs. All right? And look at the market as they come off these lines. They make another effort, this time almost all the way to the 786. Had they hit the 786, that would have been a huge trade. We're not going to talk about that here. But down they go. And here are our opportunities. Down, down. All these opportunities to trade down. All of these trades are further than 5 to 8 pips. Let's just see right in here in the consolidation part, okay? Let's just say that we entered this trade and we ended up going sideways. How would it have looked had we just simply put a 30 pip stop? Well, we have a little tool we call the pat projector. And if we put it on here where this arrow is right here, and we tell it we're a seller, you see I have mine pre-programmed to show me where a 30 pip stop is and where a 55 pip limit is. Why do I have that? Because I don't trade for 5 to 8 pips, I trade for 55 pips. Why? Because I only have to be 40% right if that occurs. All right. Notice, from that line, that's where we started. My stop would have been there. So no matter, even on this trade right in here, we never, ever got stopped out. Look where the 55 pips goes. Right to where they were going. All right. And this is critical for you to understand. Okay. Target trading requires that you know the exit before you make the entry. All right? There are lots of opportunities once you know the exit to add to a winning trade. Okay? You can see we could add it here, 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 we could add it here. All of them looking for 55 pips. Now, notice this one right over in here. This is what I want to draw your attention to. Why we still get a signal, but because we know that the target is right here for 55 pips from here, and we also know the 618 is here, this is a trade we would not trade. And remember I said earlier, it's just as important to know when not to trade as it is to know when to trade. And most retail traders, because they don't know where the target is, they take trades right in front of the target. And of course, the reaction to hitting the target is that all these traders get out of their cells. How do you get out of a cell? You buy your way out, and there it is. And they get stopped out here, and they wonder why. Why did I get stopped out? And the answer was, you didn't know where the target was. You didn't know that you were 8 pips from it. Therefore, when you entered your trade, it went down 8 pips. You thought, oh man, I'm in a great trade. And it immediately reacted at the target and bounces up 50 pips, stops you out at 30, and you take another loss again. And you are entering the realm of the 90% of the traders who fail in this market. The 10% who make it because they are target traders. They don't settle for a 5 to 8 pip trade. What they do is they stack the deck in favor of them not having to be the best trader in the world. Therefore, they only need to be 40 to 50% correct, and they can still make money, risking very little, 1 to 2% of their account, and they can make all the money they need to make. All right. So, as you can see, target trading is so powerful. You have to know where the targets are. Not only do you have to know where the targets are for a trade to be made, you have to know where the targets are so you know where not to make a trade so you can look for the reversal. Once you know where the reversal is, you begin to look for your signal. Look how easy it is to see right here. Here's our signal. We've already hit the 618. Our signal goes down. Look how easy it is to take this trade. There's a 30 pip stop. Our stop was you never got more than 6-8 pips off of your entry here. And down you go for 55 pips. And in this case, you had 1, 2, 3, 4, 5 opportunities to trade. And you now know not to take this one right over here. Why? Because there's your target. You see, target trading is the key to trading. Now, in our next video, we're going to actually get deeper into this. We're going to look at the day chart, the 240 chart, and the 60 chart. But this time, what we're going to look for is support and resistance. And we're going to look at how we put stops on trades, okay? How do we do this? How do we know we have a good risk and reward trade? And we're going to show you how to do that so you don't want to miss that next opportunity, all right? So you want to make sure that if you've got a question, down below this video is a place for you to place a comment or a question. We answer every single one of them. So just feel free to ask away, ask a question. You do not want to miss this next video, because this next video is going to start to put it all together for you. And don't forget, send this to your friends on Facebook, on Twitter, whatever you use. Send it to them, because what you want to do is you want to end up with a trading buddy who you know, who you're able to trust, and you can bounce your ideas off of, especially when you both know and can define the targets. You'll keep each other honest and keep yourselves from clicking out for 5 to 8 pips, and you'll join the ranks of those people who make money trading the Forex.